So, when I was entering the world of finance, that time Doordarshan was the main, the channel, the TV which we used to watch. And that time I had listened to Ramesh ji, and the one whom I could connect with in terms of what he said. I can't remember exactly, but so I have a distant attachment to him in my evolutionary journey in finance as a student. And I'm so privileged that I'm able to sit with him and discuss about markets, economy, compounding wealth, compounding wisdom. He is India's most revered legendary investor. He comes from an engineering and technology background from US, and he started his journey at a time when Sensex was 500 points. Can you just imagine Sensex being at 500 points way back in 1985? So 4 decades of experience. He has exemplified Warren Buffett's value investing style in India. When youngsters talk about multi-baggers, I think the one name that resonates in India is Mr. Ramesh Damani. His ability of identifying some of the multi-baggers like Infosys at the very early stage, United Spirits, when the liquor industry was totally out of favor and disdained in India, and then recently catching up with the PSU theme when it was most hated is something that we can have great lessons to learn from. It is my honor, and I feel that you will greatly learn on a face-to-face gathering from him. Although in today's environment, there's so much of stuff which is also available on social media, but there's a different sense which happens when we are actually sitting in the hall and living that experience. So I request all to welcome Mr. Ramesh Damani.
Thank you so much. Before I let him speak, I'll say something. They say a great teacher influences eternity because you never know where his influence stops. I think just looking at alumni that is gathered here and the stories I've heard from Sumangal about how many people he's taught, you're going to find eternity, sir. Congratulations on a great job. Congratulations on the anniversary and best wishes for the future.
Thank you, sir. I was just telling him that, see, this is the first time that I am taking somebody's interview. Okay? So, nobody should judge me that much. And number two, I don't know whether it is with some of you on the other side, but I have become very emotional out of the initial 10 minutes that I spoke. And my rational side, the brain and the heart, the brain part is, I think, not at its optimum. So please excuse me for not being super perfect.
No, you're great, and I'm actually amazed at the level of influence you've had in this. One of my heroes in life is Charlie Munger, and he said that the biggest foundation advances in civilization happened when the Venice merchants discovered double entry bookkeeping. So I'm well aware that in a crowd full of CAs and CPAs, how much they've done to advance the cause of good civilization. And you've been a very instrumental part of that in India. So thank you.
Thank you, sir. So let's start spreading your word of wisdom and knowledge over here. I'll do my best to get the best out of you.
Sure.
So, sir, would like to start right from the beginning. Like, you are coming from an engineering and technology background. And obviously, as a teacher, I have seen many of my students who do come from that background, but they have inhibitions. as to in what manner would they take up this finance industry. So when you recollect your past days, when you were entering into this field of capital markets from an engineering background, how did you approach the field? What are the pluses or minuses, okay, that you seem to have faced when you entered this industry as compared to a normal commerce guy? Because you might be having some of your friends who were purely from a commerce discipline. So how do you differentiate the two?
Yeah, it's a good question with how I got into the stock market to abbreviate your question. Um, I was the only son. I was studying abroad, and I had to come home because the parents kind of pull you back at that time. So I was one of the few guys who actually made the reverse journey. Most people went from India to America. I came back from America to India. But in 88, 89, when I first came to India, after studying abroad, the market was still like in the backwaters. The people who made money there were the jobbers, the speculators, the insider traders, they all kind of made money. The very few people who believed in actual value investing or believed in good stocks to buy. But as they say, friends of a feather flock together. The kind of people that I happen to meet were today they're of course worldwide legends. But at that time they were very good value investors. So I made friends with people like Chandrakant Sampath, who's no longer there, he's passed away, who taught me so much. R.K. Damani, Ramesh Damani, so many of these people who are actually truly, when the history of the last is written, they will written, whole chapters will be devoted to them. So luckily I stood on the shoulders of giants and I learned the business. Because my background in America taught me one thing, that a great business can grow at 15-20%. So all these people will come and tell me, ये tip मिला है boss, double हो जाएगा share, ये ले लो, इसमें कवाड़ा कर लेंगे, ये इसको संस्था को दिला देंगे. I never believed that stuff. I believed that a good business can grow at 18, 20, 25%, and you want to search for those kind of businesses. And all the friends I made also believed in that. If you go back and study the history of the last street over the last 30, 40 years, all those people who thought they were supreme in the market, they all had adventures in Arthur Road jail. So the people who actually understood value investing, didn't work jobbers, were trying to make a honest living, have survived and prospered in how over the last 30 years or so. So to give you, I think what helped me was that I had the right set of friends in Mumbai when I came back. And because of my experience, to give you another example, in 89, there was a big cement boom going on in this country. And the trouble was that even my jobber in my office, lowly jobber, a few thousand rupees, would know the price of cement in, say, Bhopal, or cement price in Coimbatore. And I was an MBA from America, and I had no idea what the cement prices were. I had no idea the cement industry as such. I couldn't name a cement company. That's because cement is globally an important business. It is a cyclical business which is getting a boost in India. But luckily, as Sanjay would attest, I was a techie, and then when I came back, Infosys went public in '93. So I was one of the few people in the last year who understood the value of that business. It didn't have plant, it didn't have assets, but it had intellectual property. And I realized the value arbitrage between India and America in terms of software. So I was one of the first few people to understand the software business, and that, if you might add, is my lucky breakthrough.
So somebody told me, I just complete your answer in the sense that the knowledge that we take in understanding a business has nothing to do with our background, whether we come from commerce or from science. And business is more of common sense. If you dig deep, you can really unearth a good business. Okay, so the fact that I have been teaching and I've seen that people identify finance with just accountancy, I think that is too backward looking. In the sense that accountancy is not the main stuff which is required for the purpose of identifying great business. Do you agree, sir?
It's important. I won't say it's not important. I think some things are very important. But I think, how do you capture the character of the entrepreneur? You can't do that. That you can only judge when you go and see him person to person or by his track record over so many years. So, while it's important to understand the numbers, it's clearly not the most important thing.
Okay. Uh, the second question, sir, is that I have always heard that you are a great leader. Okay. There are some talks about the fact that way back then you were the only person, apart from SBI chairman, who had a copy of the Wall Street Journal in Mumbai. So, how is it that reading so much and keeping on learning has helped you in markets and has always made you a little bit more competitive as compared to others?
Yeah. Great question, thanks. First, let me share a story with you because it's very close to my heart. I have two grandchildren, they're 8 and 6, and when my grandson was 6 years old, he was overseas and he's missing his dadu. So we told his dad to put me on Facebook to talk to him. So when I talked to him, he said, "Where are you, dadu?" I said, "Son, I'm in the office, it's 4 o'clock. Where else would I be?" He says, "You never work in the office." I said, "Who works you think in the office?" He says, "Whenever I come to the office, you're always sitting on the sofa reading a newspaper." I said, "Who works there?" He said, "My papa, he's always on the computer." So that shows you my extent to which my family thinks. My wife always tells me that I'm a book with two legs. I really enjoy reading. But let me explain to you how reading helps. You're young in your careers, you're all looking ahead in the next 20, 30 years. And one of the stocks I bought early in my career was the liquor companies in India. So they were available, 200 crores each, United Express and UBP at 200 crores each. So to give you perspective first, that you could buy 10% of the company for 20 crores. This is as late as 2004, 20 years ago. 2004, you could buy 10% of the company for 20 crores. Let me put it another way to you. For 20 crores, you could barely buy a flat in South Bombay even at that time. But here you can buy 10% of these liquor companies. What does that mean? It means that out of every 10 bottles that people drink in a party, one was mine. If I own 10% of the company of that. Now, how did I get this flash of brilliance to say invest in these companies? I think it was reading, Sanjay, because I used to read extensively, so I read what Harbin beer in China was trading at. There's a city in North China called Harbin. They had a brand called Harbin beer that was sold for $1 billion. San Miguel in the Philippines, Singa in Thailand, Anheuser-Busch in America. I knew what the values of the beer were. And I couldn't understand why these companies were being traded so cheaply in India. Then, when I asked fellow analysts, they always told me, "Oh, but it's run by Malia." It's like, he's never going to, he loves to party, he loves to be the biggest yacht owner in town, he's not going to make money out there. But there's one dictum in the markets that you should always remember, that price discounts everything. At 200 crores, I could go down to 180 crores, I couldn't go much further. At the end of the day, a fabulous business that was in there with drinking habits, young population, demographics in your favor. But I had one insight thanks to my reading. Every time I would see Bombay Times, there'd be a photo of Malia prancing with some Bollywood heroine or throwing a party or doing something. And I knew that Bangalore by that time became a global size city. That if you remained market cap of 200 crores, you would not be the biggest wheel in Bangalore, you would be the biggest parties, host the best people. You would become irrelevant almost. And that's something that Malaysia would not allow. That helped me because I read. So I read about global values of liquor, I read about the personality, the psychology of Malia. And that said, okay, maybe there's a trigger coming in the next few years for McDonald's. And that could have happened. But the question that Munger and Buffett always tell us is that you read just to become a little bit more intelligent. You don't read to find a particular stock idea. So my suggestion to all of you, if you ask me, is just read. Read a lot. It just helps. Biographies, politics, philosophy, current events. Just read. It just helps overall to be a better stock picker.
Nowadays, students, in terms of reading, they are using a lot of GPT stuff to summarize their reading. 500 pages, summarized into 10 pages and bullets. I do not know how much in depth they would be able to do, but they are doing good. So maybe times are changing and time alone will say what type of.
I think it will be dangerous. My sense is you should just read for the love of reading. and you try to summarize everything, you go to summarize your results too. So my sense is long form reading has some value here.
Yes, sir. That is the differentiator. Coming to the India story part, which all of us are now witness to, I'm sure even at that time, if you recall 85, and you would have imagined how this country will shape up in the next 40 years, of course, along with the global economy. Nobody could figure out as to where we are standing now. So the journey from a state of affairs we had with this country way back in 1985 and today. Number one, you feel proud of it as to what we have done, what we have achieved, and how do you see this? And just to combine that into one particular question, how do you see it going forward? Where are we evolving? When you see the youngsters, because this is one of the most representative crowd, of the people who are really going to do great in the financial space. So how, and plus you yourself are seeing so many youngsters when you mentor them. So this entire journey of India, कहाँ तक अपने आए हैं and where are we moving towards? What's your perspective?
I think I did the first part that's more interesting. कहाँ तक आए हैं आप? I find that truly astonishing. I'm probably one of the oldest guys in the room. I'm, almost getting closer to 70 than, my IQ. The age has crossed my IQ now, I would say.
Average age in the room, we have collected the data, is 28.
28. So, you guys are born after I came back to India to start my career, but leave that aside. My generation, we call midnight children, you're born a few years after independence, 45, 55, somewhere around there you're born in that time. Sanjay, there's a saying in the English language that you understand your life backwards, but you live it forwards. Okay? So now when I look back at my life, I realize that my generation of people, we were the blessed generation in India, we were the gifted generation in India. We came of age when? In 85, 89, as you mentioned to you. What happened in 89? The Berlin Wall fell. The world changed. What did the Berlin Wall fall represent? I didn't understand at that time, but what did it represent? It represented a triumph of capitalism, of free markets. The stock market is the symbol of free markets. Alright? 89, the Berlin Wall fell. 91, what happened? India had to liberalize because we had no choice. After the Berlin Wall fell, these countries out, India liberalized. What happened by 2000? India became a tech superpower. Look at the enormous tailwinds my generation had going forward. So I think for us, those who believe in value investing and those who believed in buying good businesses, I don't know if you remember 93. Does anyone remember what the market cap of IPO at IPO time of Infosys was? Anyone has an idea? Not you, Somal, you probably heard it from me. So anyway, IPO, the biggest Indian wealth creator in its generation, IPO had a market cap of 40 crores. It was like a 4 crore equity with a 100 rupee price. At 40 crores, today it's closer to 6 lakh crore, 8 lakh crores, something in that neighborhood. Okay. So, Reliance market cap was I think $300 million in 91, 92. ITs were $200 million, if that, at that point. So it was almost like shooting fish in a barrel. If you got bullish in India and you remain invested in great businesses as ITC or Reliance and Infosys were, you couldn't help but make money. So anyone who tells you that, in fact, what I say to people that what I find the saddest when people come on television or people come and tell me, that I've had a good day, I made 20 points on a stock today. But the opportunity sometimes is to make 20x your money, not 20 points in a stock. If you remain invested and believe in the business, which at that time, 89, is a relatively small cohort of people who believe in the great business can compound over long periods of time. It has changed now. Today there's a much wider circle of good value investors in India. But my suggestion to all of you, particularly because you're in the CA and the CFA business, you get a lot of information from people, your batchmates, your colleagues, your office will have a lot of information. But don't look at it as a way to make a quick $10 or $20. Sometimes it may be fun to do that. But the true wealth is created by making bets on great long-term businesses, which have good cash flows, good return on equities, and can be held for long periods of time. And astonishing wealth creation can be taken. Now, just to cut forward to the next question he asked, what do I think about the future? And the answer, Sanjay, that I've had the privilege of meeting some of the best investors out of India, like I told you, Chandrakat Sampath, R.K. Damani, Ramesh Damani, so many of the great value investors who, when the chapter of the last year, and believe me, they'll have individual chapters. I won't, they will definitely have it. And I mean that in all sincerity. And I often ask them the same question. I said, so which has been the best decade to invest in India? Was it the 90s when Manmohan Singh liberalized the Indian economy? Was it 2000 when India became a tech superpower? Was it 2017 when Narendra Modi became the Prime Minister? Which has been the best decade to invest in India according to you? And almost uniformly, they tell me the best decade to invest in India would be the next decade. Right? So the opportunities ahead for you, 10 years, are far greater than the opportunities, despite you come to 80,000 index. Despite that, the opportunities are far greater in the next 10, next 20 years than they were in the last 10, 20 years. The one paradigm that I found, one proverb that everyone has always told me whenever I met them, privately, publicly, and the ones who got it right were said that we are always bullish on India. They realize that the confluence of factors in India, demographics, digitization, all are helping India. And because they remain bullish in India through, when we came, for example, the income tax rates were 90%, wealth tax was there, regulation was there. They realized that everything is going to be dismantled over a period of time. And if you look back through the prism of history, everything has been dismantled. Today, I think in many ways we are more free market than, say, even America. Our settlement systems are much better. Our banking system is not being pressurized by the Prime Minister. So I think we're in a good spot, sir. So to answer your question, yeah, we've come a long way, but can we go still a long way in the next 10, 20 years? I believe we can.
Yes, sir, that's true. And that is the optimism sitting in front of us. I had read the phrase, nurse the baby, protect the child, and free the adult. So, somewhere India represents these stages where we were perhaps nursing at the time when you were there. And then throughout your period, you found that the baby became a child, and perhaps now it's an adult. And this adult is roaring like anything. We go abroad and we feel so proud in speaking about the fact that we are Indian. And that's a great future that we have. And it's all thanks to everybody who has participated, especially in the capital market and people like you who have had confidence in businesses.
Basically, the tech people, my friend, it's basically the technology guys that gave us this kind of bandwidth. I mean, this was the Infos gave a market of 40 crores. I think we had, maybe $200 million of the sales. Today it's a $200 billion industry. So, I think we owe a huge round of applause for our tech people because they've actually put us on the map.
So over these last 4 decades, you have experienced so many cycles. The markets have really, like 2000, post 2001, they really shot up like anything. And then so many collapses that you have seen. During these market cycles, it is always said that youngsters can only read about those cycles as to what happened, but you lived the cycles. And you must have, at various occasions, had very nasty lessons from the cycles, and you thought that I will in the next cycle capitalize or prevent myself from being hurt from the same. Can you elaborate on the same as to what lessons these cycles taught you and how in the next cycle you were better prepared that?
Of course, thanks, Sanjay. My story has been told, so if I'm repeating it, please excuse me. My father, as I said, was interested again in the stock market as in America. And so he made a bet with me. He says, I'll give you $10,000, you invest it in stocks in America. You double your money, it's yours to keep. You lose the money, you don't owe me any money. So that seems like a fair bet to me. So as luck would have had it, lost the entire money that he sent to me in a few years' time, which of course led to a lot of introspection on my part. That how could I lose money? Because there's a bull market going on in America. And I realized the first fundamental mistake you make in the market is when you're driving, you should look at the front view mirror, not the rear view mirror. What do I mean by that? Sanjay, 1970s was the years of commodity inflation. So gold, silver, oil, all the stocks are going up. And by 1981-82, the stocks have fallen 70% or so. So in my naivety, assumed that stocks are down 70% of the highs. There will be some value there. Why reinvent the wheel? Little realizing the stocks will fall another 70-80% from the prices with which I bought them. Okay? So I learned first that each bull market has new leadership. So you can't go back to the last bull market leadership to do that. So that was one of the first lessons I learned, and I never forgot that lesson, that each bull market has a new leadership. So for example, when we came back in 1990 in India, cement was the leading bull. Everyone was talking about cement. But very few people understood the technologies of how to overtake a lot of industries in India. But because of my not understanding cement, I looked at technology. And because of my background, that helped me out there. So after that, I've always tried to look at the next emerging theme of bull market. One thing about bull markets is that all bull markets end. There's nothing in the permanent bull market. Even this current bull market, as great as it is in India, it will end, no doubt. By its own volition, it will end at some time. It will be followed by a bear market, the prices will fall down. And then a new bull market will come. That is the nature of the business. Just like after every monsoon, we give way to next year to summer and again to monsoon, the same thing will happen in stock market. So if you go back and study the various bull markets in India, say the 92 bull market, 2000 bull market, 2004 bull market, or current bull market, the leadership is always giving a lot of money, like 30, 40, 50x on that stock if you happen to get into that stock at the correct time. So I've spent an enormous amount of time, Sanjay, looking at is the bull market starting and what will be the leadership in the market when the bull market starts. So I think that has helped. Again, there's a big difference between me and other fund managers in that sense that they run public money, so they are answerable to the public. So, if they underperform, they're asked a lot of questions, they face a lot of answers. Whereas I run proprietary capital, my own money, so I'm not answerable to anybody. I can pretty much bet as I choose out there. So that gives me a lot more freedom to do that. So in my head, even if a stock doesn't perform 2-3 years, I am still okay holding it. Because I think it will eventually perform. Because I think my thesis is right. So I think the first thing I realized is that you need to find the leadership in the bull market. And the second thing I realized very early on that the big money is made in the big swing. You'll be very happy one day. I mean, my son had his aha moment when we talked about these liquor shares, for example. I told him to invest in appreciating assets and not depreciating assets. You will all understand that, right? So, when he was going to the college student in America, I told him that he could buy him a smartphone which was costing 50,000-60,000 rupees at that time, or he could buy shares of GI which was like 40 bucks at that time. And of course, he chose the phone. If only youth knew, he chose the phone. But then when he came back for a summer to the office, that one particular day, I think the stock of McDonald's was up 20% from a base of 300. So it gone up like 60 bucks. For a stock that from 40 bucks, it's gone up 60 bucks. So that was the aha moment for him, as he mentioned to me. So it's very important when you're young to invest in appreciating assets, not depreciating assets. And think long term. I mean, if you think the Indian economy is per capita, democracy, demographics, all will increase in our favor. We are still very underpopulated in terms of per capita in so many things. So I think these businesses will tend to do very well over a period of time. So I think the one thing that I'm very clear about is that every bull market should make you richer, prosperous, stronger. Bull markets change the course. We don't understand it when a bull market starts, where the country is, where the company is, and by the time the bull market ends, I mean, when the bull markets of technology started, where was India as a technology power? When ended, India became a household name in technology. And that's true of every bull market in every corner of the world. So I think the other thing that, just to add some more fuel to your thought, I think over the last 20-30 years, only 2 or 3 markets have shown positive correlation year on year. I think America is one, India is the other one. the last major markets. So we're, as I said, we're a blessed generation. Good place, good time, and I think that good time will continue to roll.
In your answer, you in fact answered even the coming questions. Because if I would have asked you about when you identify multi-baggers or you identify a correct phase where you feel that yes, the bull markets are now going to start, and when that does not happen, okay, and you hold on to it, so the conviction every day the screen shows that something opposite is happening to what you are believing. We were just watching the interview of Stanley Miller. Okay, I and Suman were sitting together only, and he was speaking about the fact that he entered the phase of the dot-com bubble quite early, where he understood that there's a problem, and he went short, obviously, as a hedge fund, and he could find that even though he went short, the rate continued. And ultimately he had to square up position and went long. And when he went long, and he went terribly long, it just the crash came and he was out of the market. So you answered it that it depends upon whose money are you managing, whether it's prop money or it's other people's money, and also the patience, obviously, that's there.
You know the story about this because I think the audience might enjoy it. Being early is the same as being wrong in the stock market, particularly if you use leverage. So there's a fund manager called Bill Ackman. In April 2022, he turned very bullish on Netflix. So he bought $1 billion position in Netflix, 3 million shares at $13 a share or something, put $1 billion in Netflix. The next 6 months, the stock collapsed 30-40%. 30-40%. So he had to liquidate the position. He was running public money, he had to liquidate the position. But even when he sold it, he made a public statement that I'm selling it because I've been wrong on the stock. But I think the long-term fundamentals are very positive for the stock. And you should remain invested in this if you're a retail investor, he said that. And he got out of this, took on a $1 billion investment, he took a $400 million hit. So he lost 40% of his capital almost in the stock. Yesterday, Netflix was news because of some merger acquisition they're doing. But if he had held on that $700 million position, mark to market $7 million, today we will be worth about $3.5 billion. There's a 5x move in 3 years in dollar terms, which he gave up a bit too early. So that's the risk of running public money, that's the risk of... I think the other thing that helps prop investors is you do your homework. Okay? For example, sometimes you can hold a stock 50x or 100x, right? For example, McDonald's has been that kind of stock, Bharat Electronics has been that kind of stock. So the question I'm asked is, how come I didn't sell it? So let's say I bought McDonald's at 200 crores market cap. And the stock doubled, it went to 400 crores. The stock doubled, went to 800 crores. But I done the homework, I knew the value of the brand, I knew the value of the Indian market. I mean, how could you sell this? This is worth 800 crores. You in the head, you think it's worth 10,000 crores or 20,000 crores or some amount like that. So then you wait for that terminal value to start coming into business. So if you do your homework, and that's something that is within your wheelhouse, all of you. You're all CAs, you can run Excel spreadsheet without a problem. You can do your homework, you can figure out, this is the value of the business, I think. Why should I sell it because it's doubled or tripled or even quadrupled? That's how allows you to remain into your stocks for longer periods of time.
That is the most quality which is lacking in many of the youngsters, okay, to think so much of long term, because many times conflicting wisdom come into their mind. Like many of them tell me that, you remember that proverb, market can remain irrational for a longer time than you will remain solvent. So it works.
That's why don't leverage it. That's simple answer to that.
Don't leverage.
Use your own money. I mean, whether you manage public money, you can't do it. I appreciate it. When you manage your own money, you can take those calls.
Correct.
I've seen so many people do it successfully. And don't leverage. That's really most important.
Okay, sir, the next thing that comes into my mind is that I'll just frame the question with an example, okay, because I'm being a teacher. Okay, I'm feeling so many times when you are giving the answer that I start explaining to them in a different manner, but I'm preventing myself. So this particular question comes with a particular context. There was this company which made a lot of news around 3-4 months, I think 6 months back, Siam Agro. I think that was the name. Siam Agro. Was it the name? In which Nitin Gadkari's son had a stake. And this company really went 10 times or 20 times revenue and 20 times share price in no time at all, And when it spread among the masses, people, it was the talk of the town. We can have conspiracy theory or whatever. But what happened is that I was taking a class, and as a part of the class, when we were talking about fraud detection and all that, I was telling them as a mental framework, why don't you do something? You pick up any particular platform, say GPT or whatever, and you ask it to generate the names of all the ministries that we have in India, okay, and the related persons. And then you map it to the entire listed space, the ministries and the entire listed space. And maybe you will be able to get a universe of the stocks which are politically sensitive, okay, and stuff like that. To my surprise, there was a female CFA level 1, and she brought the same list out, okay, as in the chat on chat GPT next week, saying that, sir, I have done the same. I brought out all the ministries, the people related, the public listed space, okay, and how are they related. So, what I am trying to come to the question is that artificial intelligence, which is the top of the town, the entire US market seems to be just a bet on artificial intelligence. In our area, these people who are there in regulatory compliance field, who are there in investment analysis field, who are there in fund management, who are there in both public fund management as well as even private equity and private credit. Now these people are not able to be clear about the fact that how much of AI would replace these particular professions, and the way in which we used to find out companies, okay, the best of multi-baggers and all that process is obviously reshaping. So the human skills which you have spoken about in your entire discussion about going deep and judging companies, human intelligence, human judgment, how much of it will be replaced by AI, or how do you think this entire field evolving? So the short question is, what is your view about AI versus HI?
The most difficult question, yeah. I don't know, I mean, the AI is about my pay scale, so I'll start off with saying that I'm not an expert in AI, so I don't know how to reflect. I understand, from what I understand, that AI will replace medical professionals, doctors, because they will do better surgery. They replace legal people, they represent, so many professions will now be replaced by AI. I believe that. Will they be able to replace mother's touch? Will they be able to replace investment insight? I don't think so. I mean, in effect, if someone can tell you what stocks to buy tomorrow, and that result would happen, then the market will be over. I mean, there's no such thing as stock market. If someone can predict the price tomorrow with certainty, then everyone will buy the stock. So then all of the stocks will work out. So I don't think that is going to happen in the near future. I don't think any AI will be able to predict mass psychology. The key, as Warren Buffett explained once, was that the key to buying stocks and getting rich in the stock market is when others are fearful to be bored, and when others are greedy to be out of stocks. So I think that psychology doesn't change because human nature doesn't change. Human beings will go through movement bust over various periods of time. So while they'll help you to read an analyst report or summarize research or pull out more research, I don't think it will replace human judgment. So I'm not. If I was a medical doctor or a lawyer, I wouldn't be worried about obsolescence. Will I have my job 20 years from now? I think the stock market probably will still exist because capitalism doesn't exist without it. So I think it exists.
That's a great call.
I hope so.
Yeah. But I'm definitely sure that you would advise all of us, as in all the youngsters, to use AI for the purpose of increasing their efficiency in analysis.
I mean, you should, but it doesn't replace deep reading. I feel it doesn't. It's just my way of thinking. I think you should just enjoy a good book on its merits without trying to get an exact summary because, I mean, your point that you might get in the book in chapter 3, paragraph 2 would maybe missed by AI. I don't know that. So, you can use it, of course, as an efficiency tool, getting your tickets done for you or, scheduling surgery or, doing research on where to vacation. There's so many good use cases, but whether you should do it as a substitute for reading or substitute for thinking, I doubt that.
Okay, sir. Given the fact that the one whom we worship, as in Warren Buffett, is holding so much of cash right now, and we are at a particular stage as far as global capital markets are concerned and Indian markets are concerned, say for the next 10 years or so, from an asset allocation perspective, how does one think as to whether to keep dry powder ready for the purpose of investing in markets if the markets at all fall because of global factors, or to just remain invested in quality stocks which have been unearthed by great research? How do you mentally frame your own money management in this area?
First, I'll share. When I was a student in America, Surajji, I went. I don't remember how, but I heard of Warren Buffett when I was 20 years old. I heard about it, but and I'll tell you how I remember it because when I stayed in California with my sister, and typically when people are in LA, they'll say, "Oh, I'll take you to Hollywood, or take you to Disneyland, or take you to the beach. I want to see the exciting things in LA." And I remember I was 20 old telling I want to see Seas Candy, which is one of Buffett's investments, or go visit a Walmart. I'm not going to brag, but that was quite head and center. But then a few years later, that not in 77, but a few years later, I went back and checked what the price of Berkshire was in 1977 when I was a student. It was about $75 a share. So, in fact, in 1977, I got about 1,000 shares of Berkshire, paid $75, $75,000 would have been my cost for doing that in 1977. $75,000, give or take a few $1,000 here or there, right? Cut forward to 2025, which is almost 48, 50 years. Does anyone want to guess what the value of those 1,000 shares will be today? 20 million, there you go. 20 billion? Oh my God. What is the compounding there? Not 20 billion, it's not even close. But another guess is this side. Which is the team that won? Which is the team that won the quiz? We'll ask them. Which team? Your teams are? Give me a guess.
I think $1,000 what you said the price was?
No, the price was $75.
$35.
75. Come on, someone has a guess here. Take a guess. He guessed 20 billion. Somewhere between 0 and 20 billion. No, Sundar would know. I know. Sundar can't answer the question. It's inside information. So he could probably figure it out. Someone else. Someone has an idea.
700,000 a share, 1,000 shares, so 70 million?
It's actually 700 million. 700,000 times 1,000 shares, 700 million. I still think that mistakes don't do that. I think you can certainly no, it's $750 million US. So in effect, bought 1,000 shares, not paid any more fees, sat on the beach, bumped around, traveled the world, I'd be far richer than I am today, believe me. So that is but the astonishing fact of that is that over the last 45, 50 years, Berkshire has compounded at 20%. Okay? 20% compounding. So what is important for you all to remember is that not only compounding is important, the rate of compounding is of course very important, but the longevity of compounding is so much more important. If you get something that's going to compound at 30, 40 years at that rate, it's going to lead to a huge fortune. I'll give you an example from the Indian stock market, which you may not be familiar with. There's a public sector company, Suresh, called Bharat Electronics. When I started my career, it was at a 300 crore market cap. So it had I think 80 crore equity, 40 rupee price, 320 crores. And a 2 rupee dividend, so 5% dividend yield to boot. After I bought it at 40, it went down to 20 rupees. So it was 160 crores market cap. This is about 96, 97. Okay? Cut up to 2025. Today, that 100 shares is worth 10,000 shares. By bonuses, splits, is worth 100 shares worth 10,000 shares. The 10,000 shares at 400 rupees. So you can figure out the market cap of that company at that time. The market cap today is about 3-4 lakh crores from 200 crores. It's 3 lakh crores. And the dividend you get per year on that share is probably double your cost price. So that is the wonder of compounding. Now someone asked you to use the best example or one of the best examples, but you always want the best example. Why would you take the stock picking is not easy. It's a very difficult business. Don't ever think that कुछ भी लेना बढ़ गया ऐसा कुछ होता नहीं है. Long-term capital allocation is my job, and you have to look for the best examples in life. You want to look at who's the best tennis player, who's the best mathematician, who's the best architect. You want to look at the worst in your field. Alright, so long-term is very good, but there are ample opportunities like that available in the Indian stock market. For some reason, we are blessed. We have these opportunities. So I would say compounding is actually the eighth wonder of the world. And you all CAs, I don't need to explain this to you because you all understand intuitively. But this is an example I give. I just finished with this example. I say if you're young, if you're say 30 years old in India, okay, as most of you are, the average age is 29 as you said here, so you're the perfect age. You're 30 years old, and you're thinking about the next 30 years of your life. Okay, what is my next 30 years going to be? How do I become financially free when I'm 60 years old? Okay, long term. You want short term, you go play the horses. I don't care. That's fine. But you want to make long term wealth, you start today. If you start with 10 lakhs today, and you have a 30-year career ahead of you, that means you should have, technically, you should try for 10 doubles of your money. If you move your money at 23-24%, that means your money will double every 3 years. Okay? So then, shall I have fun with them? Shall I have fun with them?
Yeah, please.
Okay, so who's good in maths here? Can you get up? Yeah. Yeah, he's good. He's already ahead of me. Yeah. So, what did you start with though? Yeah, but what did we start with? 10 lakhs. And what did we end up with? In a 30-year period. I don't know if you know what 100 crores even in today's depreciated rupee is about $10-12 million US. $10-12 million US puts you in what percentage of the public wealth? Half of 1% of the world, the 8 billion of us in the world, and it puts you in that category of that. So it's a remarkable, actually, you get up, we'll make you do the exercise if you don't benefit from your own day. Okay? Suppose you start with 10 lakh rupees and you're 30 years old. By the time you're 33, how much should you have? If you double your money every 3 years. No, 20, right? 10 get 20 okay. So now, at the end of 3 years, you have 20. At the end of 6 years, end of 9 years, end of 12 years, end of 15 years, end of 18 years, 640 lakhs or 640 crores? 640 lakhs here. 6 crores 40 lakhs, right? Now keep doubling that. 50 and then 100. Yeah, so you just see the math. I mean, this is not me speaking. See, the Sensex itself compounds at about 15-16%. The last 40 years, you made 16% of the Sensex. If you add 2-3% for dividend yield, you're getting 18-19%. I'm saying do 23-24%. You're a bunch of guys and you should be able to do that. Okay? Think long term. That's where the true wealth is created. So there is no reason that anyone in this room cannot become a crorepati or self-sufficient if you follow this path. You're not going to get there in 3 years, but in 30 years, I think mathematically the odds are very high that you'll get there. So my humble request to all of you, because you're a very enlightened bunch, you're CAs, CFAs, you deal in public money, you understand accounting, pause and think about it.
So many of these people have perhaps at some time in their career learned the rule of 72, which we were elaborating upon. For those of you who have forgotten or have not learned, we do 72 divided by interest rate. So Sir said 24%, so 72 by 24 is 3 years. 3 years was the doubling period. He said 30 years, I think. 30 by 3 is what? 10. So 2 power 10. 2 power 10 is what? 1024. Raja, have you learned 2 power 10? I'd like to corner him, you know.
Okay. He did actually, and to be honest with you, well, you're right, he did do that. Rakesh Jhunjhunwala, Sumangal's ex-boss in India, did 40% plus compounded over his lifetime. He had unfortunately very short life. Extraordinary, absolutely extraordinary. To do 60% is almost unbelievable. Do 40% in dollar terms is almost unbelievable up there. I mean, to me, they're like Donald Bradman's cricketing average. You know? When you retire, you're cricketing average 99.99. I don't think anyone's going to come close to it. The record that will stand. So that's amazing record.
So sitting over here, it feels that the type of bullishness you have on the Indian economy, on markets per se, on the value of persistent and enduring research and holding on to them, and the faith in human intelligence as compared to any type of artificial intelligence is a treat to hear, a treat to watch. If you do not mind, how old are you, sir?
As my wife complimented me, she said, my age has crossed my IQ now, so I'm 67.
So at the age of 67, if this is the type of positivity that we have about technology, about India, about markets, you know, all of you, aged on an average around 30, can understand what great future we have. We are blessed to be born in this country at this time, okay, and we will surely learn a lot as a result of this discussion. So in the scarcity of time, although we wanted to have a lot of audience questions, but this particular guy, he has studied all night about you. Okay, he has studied 10 hours about you, he was telling me in the morning, and he wanted to ask you a question. So as an audience Q&A, I'll just have him answer one question. Okay, please be brief.
What's your name again, please tell me? Okay, lovely. Thank you, Raja.
Can you introduce yourself once again? Because
My name is Raja Roy. I'm a quant trader from Calcutta. I've been associated with Sanjay Saraf for around 25 years. And currently I feel the universe is smiling at me because I went through a lot just to be here, just to be with him in his program and to see him. So yeah, it was difficult with Indigo to just get here. But I really hustled to get here.
Thank you so much for making it. It's been tough, I know, flying all the way, but I'm glad you did.
So in one of your shows, you spoke about a friend who invested in HDFC for his son. My question to you is, my son is 9 years old. Can you give me one coffee chat?
You know, as much as I'd love to discuss stocks with you, maybe you can talk to me, you know, because I can't discuss publicly stocks. Unfortunately, that's those SEBI rules, so I can't on a public platform discuss stocks. But I will say this, that if you have children, I guess, you have one son, right? I would sincerely urge you to start investing for him, you know, long term, you know, keep because, you know, you could put small amounts of money, 50,000, 1 lakh, and you don't know what that becomes 30 years down the road. The principle is that you must invest in depreciating assets for your children. Because you give them the most important gift you can, one of the more important gifts, so financial freedom, when they reach college age. By the time they're 25, 30, and the big tickets will come, the marriage, their housing, their medical expenses for you, the travel, you know, they will be financially free. So I would sincerely urge everyone in this room with young children to start investing not only for themselves first, but also for the young children.
So just want to share with you, my son I can't follow him right now. But if you ask my son what he wants to do, he'll say he wants to trade the Nifty.
He wants to
trade the Nifty, and he's 9 years old.
How nice. How nice.
Thank you, sir.
Yeah.
Thank you, sir.
Thank you, Raja, for being frank. Uh, we will now have a rapid fire round. Okay, and you'll have to answer as short as possible. Okay. So the first one coming your way is one contrarian market view you hold today.
I think that what we are seeing right now is the decline and fall of America. I think America's leadership in the world that began after World War II is coming to an end. It won't happen overnight, but it will gradually decrease and then completely disseminate. I think I'm very clear that this is probably one of the last gasps in America. I mean, that preeminence that they had, they're doing it to themselves, by the way, but I think that will decline.
One investing hero or figure that has had the most significant impact on your career.
I think in America clearly will be Warren Buffett, Munger. I think India is someone called Ramesh Damani, who's one of the promoters of DMart. I've been a huge fan of this.
Your golden rule on investing.
What Raja said, double your money every 3 years. That's the key to wealth. Double your money every 3 years.
Diversification versus concentration. Where do you stand?
I have had better luck with diversification. So, I'm trying to double my money every 3 years. So concentration se hota hai, double kuch farak nahi padta hai. But concentration is a better way to go, but it requires a deep knowledge of your individual company, which I may not have. So, diversification.
That's humble, sir. One sector or theme you are bullish on for the next 5 years, and one which you are bearish on.
For some reason, I'm very bullish on pharma. When I go and visit companies, I realize that is a sector I would keep looking at. So I would say pharma. One sector that I'm bearish on, I'd probably avoid bitcoins. They are, as Warren Buffett said, rat poison squares. So I would probably avoid them.
The bullish one, I would also agree. Your most favorite or personally satisfying investment?
There was a company I bought by happenstance. It turned out to be, I think, 100, 200x. It was a company called CMC. When IBM left India in the 80s, when George Fernandez threw IBM out, CMC took over the contracts. And it got listed in the BSE at some 50 crores market cap or something, even less 30 crores market cap or something like that. And because of my tech background, I understood the business. And as I often tell my son, it went on to become a 100 bagger or something. So before CMC, nobody knew me in the market. After CMC, nobody could ignore me in the market because I picked a 100 bagger. So that was the stock.
And did you make the most money in it?
No. I mean, as it went on, I made much bigger bets and made more money in many other stocks. But that was, Infosys and CMC were foundational to my career because they were my first two big bets.
A book that has had a profound impact on your life or investing philosophy?
Generally, anything about Buffett Munger I would recommend you to read. But the two books of Buffett that I've enjoyed, one is called An American Capitalist by Roger Lowenstein. Another one is called Permanent Value by Andrew Kilpatrick. If you read Andrew Kilpatrick's book of Permanent Value, there's a chapter on Buffett's explanation of Coke, which I hope you will really read and enjoy. When I read it, I was so shaken up by just understanding the level at which he understands his businesses that I went out for a walk for half an hour just to clear my head. But these two books are good places to start.
India 2047, 100 years of independence. Where do you see India?
I'll tell you something that set you chattering. Index is at 5 figures now, 80,000 plus. I think in the next 25 years, it'll get to 7 figures. That's only 12% compounded, so nothing great, but I think we'll get it. 7-figure index. I won't be alive to, so if it doesn't happen, you can't blame me.
What's the one investment mistake you have made that still keeps you up at night? Not because of the money lost, but because of the lesson you failed to learn in time.
I don't know how much time you have. I have a litany of things I've done wrong. I've done so many things wrong there. So, I got wrong stocks, better the wrong management, whatever. But overall, it's been a good experience.
If you could ban or eliminate one behavior, practice or trend in today's investing ecosystem that's damaging investor wealth or market integrity, what would it be?
See, I'm not in the favor of banning derivatives or banning people from investing. I don't believe in a nanny state. I believe people are adults, they realize what they should do. What I would do on the positive side is that I would encourage education. I think people need to learn how to make money in the markets, how to think about markets. And I've often said that if you don't have the time to invest in stocks, buy a passive fund. So I would invest more in education stuff.
Between being early and being wrong, where do you draw the line? When do you admit defeat on a contrarian thesis?
Before my wife. When she says, Ramesh, I can't live the Sensex, I need money. I have to do that wrong. But that apart, I mean, you have to throw in the towel at some point, but generally I'm more stubborn, so I will stick to my positions. Again, I'm a prop investor, there's a big difference. I mean, I can wait much longer than the institution.
70% of the audience in this room are unmarried. Okay, so they don't understand the significance.
I'm going to scar them for life, They're not going to get married after that.
If artificial intelligence could replicate 80% of your investment decision-making process tomorrow, what's the 20% that would remain uniquely human and irreplaceable?
I think to, buy when other people are panicking and to sell when other people are looting, I think that's a very human thing. You have to go against the crowd. So I doubt that any machine will be able to tell you that. I mean, a lot of people tell you, pay no body, but that does not mean sell it. I mean, you go double from these prices. So I don't think machine will reply that.
Imagine you are mentoring your 25-year-old self in 1985 with today's knowledge. What's the one career or life decision you would change, even if it meant altering your investment trajectory?
I think Sanjay and I both would wish we had more hair. Clearly, no, but it's fine. I think the one thing I do regret somewhere in my life is that I've had a lot of 10, 20, 50 baggers in my portfolio. And I've often felt that I haven't bet big enough. Sometimes the trick is you have to learn to bet big enough. And I don't know whether it was my middle class background or whatever. I don't excuse it, but I haven't done it. So I would have tried to be more courageous.
As far as the hair issue is concerned, I think there was a study conducted between the correlation between hair versus wealth, and the correlation was negative. But I think that negative also stems from the fact that obviously you lose your hair as you grow older, and as you grow older you get richer. Anyways, so that was a fantastic session, sir, that you have shared with these youngsters, and many of them, they have not made up their mind on what type of temperament they have. Sometimes they are so much affected by this particular crazy stock, momentum stuff that's happening, and they burn their fingers. And most of them, they are not attuned to investing in mutual fund. They are guys who really want to run funds in future. So they would be a custodian of public money large. I think these characteristics, which may sometimes seem to be age-old or boring, lie at the cornerstone for anybody who wants to become a fund manager in future. Okay, believe me, the capital markets in India offer such a great opportunity that you can build a lot of wealth for yourself, you can build a lot of wealth for millions of people, even if you don't have prop funds. Okay, so thanks a lot, sir, for sharing this wonderful insights of yours. We will be always indebted to you.
Sanjay, it's an honor to be part of your 30th celebration, and I think the kind of influence you have, I can see in this group, and congratulations for actually a great job done over the lifetime.